Quick question. Have you ever heard of debt to income ratio? It's okay if you haven't. It's a term that we don't really bring up until we want to buy something like, a house. It's funny because your debt to income ratio is actually the amount of money you owe divided by the amount of money you make. So let's break it down. Your debt to income ratio, as stated before, is going to be your monthly expenses. So maybe your house, car, credit cards, divided by your gross income, not your net income, as in what we see on our paycheck, the actual gross before taxes. Then that's going to equal your debt to income ratio. If you are above 40%, you're in the red zone. Danger, danger. Stop, pause. Let's talk about this. This means that if you burst a tire, lose a job, have an addition to the family, get married, house burns down, didn't have insurance, insurance goes up, and groceries go up. If anything happens to offset it, it's going to be less likely that you may be able to make your mortgage payments on time. When you are at the 30% or less mark, you are now in the orange where, yeah, I believe you can do it. Inflation may not be that bad, and big business may not be that bad, and you might get some overtime. So they're going to go ahead and give you some leeway to say that it's okay to go ahead and get you a loan, but keep in mind you may have some higher interest rates here. If you are below 20%, that is ideal because this means you have positive cash flow. This means that things can happen and you still have the way to go about making ends meet. Let's talk about it. So on this screen, I have an example of Sarah Spender. Sarah Spender is a dear friend of mine, and I think I know her a little too well. But she came to me and said, well, help me figure out my debt to income ratio. I said, okay, cool. So what are things that you have, such as a car payment, student loans, minimum credit card payment, and the potential mortgage that you want to take out versus the current rent that you're paying if you're paying rent? When Sarah gave me all her numbers, she came up to $2,200 per month. She worked a great job and she was able to get $60,000 per year. This gave her about $5,000 a month, which to her was fantastic. It was a lot more than what she was making before. With her monthly expenses divided by her gross income, she was at 44%, which, as stated before, it's in the red zone. This means if the car needs to be repaired, or maybe just double up on the student loans, or she spent more on her credit cards, all these things can offset it to make making payments a little bit harder than when she became a saver. She says, okay, I understand that I'm not qualified right now, or I may not be in the best position right now. How can I save on my interest rates? How can I save on my total mortgage paid over time? I said, no problem. Just imagine if you were able to save that those $400 you spent on your car payment, you paid it off. If you were able to save the $500 for your student loans, you paid them off. If you were able to save the $300 for your credit cards, you paid it off. To the point that now all you had when you were coming up was a job with money and a mortgage that you want to take out that was only $1,000 with property taxes and insurance and everything else included. At just $5,500 a month, extra $500 coming in, she was able to add a home-based business. She then took that $1,000 monthly expense, divided into that 55, and was able to put herself at 18%. This means she had positive cash flow to really go ahead and do those things that she needed to do. Maybe such things such as take care of the homeownership expenses. There's 1% earnest money that's going to be due within 5 business days of an accepted offer. This is going to be like a security deposit to say, yes, I'm very interested in this home. I would love to make it mine. Here is a down payment to say that, yes, I'm going to go through the process to go through. When you go through the process, when you get towards your closing, you're going to have closing costs. These are going to include a down payment of anywhere between 3 to 25%, depending on your situation. If you are a homeowner, as you plan to live there, or if you're an investor, and then if you're an investor, rather in-state versus out of state, these fees can definitely vary. Also, state to state, they will vary. You also want to go ahead, and there may be some realtor commissions. The benefit of right now, there are some sellers that are actually paying the majority of realtor commissions, if not all of it. However, there are current lawsuits going on right now where the buyer may have to pay for their own representation, just like the seller pays for their own representation. But I will keep you updated on how the legal terms change, and or I'm sorry, how the laws change and what that would mean. But either way, you would pay for a mechanic, you would pay for a surgeon, you would pay for a teacher. So definitely just go ahead and take care of those experts, because they're going to definitely help you along the way. Some other things you're going to have is closing costs. These are going to be things like your home inspection. This is usually done within 20 days with an accepted offer. Again, this can vary per contract and per state. This is going to be a range between $300 to $600, depending on where you live. If you want radon, if you want special foundation, special tips, whatever you want, you can get. But this is the most important and crucial part of the actual home buying process when you select a home that you like, so you know exactly what is the condition of the property. In addition to the home inspection, you're going to then have an appraisal. An appraisal is going to be a third party from the bank that goes ahead and says, other people in this area have paid this much for similar homes of the same build, same type, same square footage, same bedroom, same bathroom, and theoretically very, very similar. So I believe that the average value of this home shall be this dollar amount. This would be what tells you if you have gained equity in your home. I've been able to see some people have $1,000, $5,000, $15,000 in equity, which is definitely amazing when it comes to just having that home equity and building those assets. In addition to that, when you get to the closing table, you're going to see a closing document that then breaks down the title and registration fees, property taxes, maybe there's a water bill that was attached, deed recording, loan origination fees, and a whole bunch of other fees that may come ahead to be included. So this is why when we say if you're looking at a loan that says 3% down, definitely have at least 5 to 6% just to be able to cover the additional cost. Yes, there are wonderful programs out there that can help you with down payment. There are wonderful programs out there that can help you go from unqualified to qualified. There are wonderful programs out there that can help lower your interest rate, as well as help bring in positive cash flow, like how Sarah Saver did by adding her home-based business. So go ahead and just have that extra money coming in to really offset those other debts. Thank you guys for tuning in. That is what it takes to go ahead and have credit affect your home buying process, and what are some costs that comes up. Tune in to our next video to go over the actual down payment broken down and how that looks on a chart per property. If you found value in this video, definitely like and hit the share button. Also subscribe to our YouTube channel. I would love to see you again next time. That way you get alerts every time we do another video like this. For more information, check out educate2own.com. And I would love to see you guys later. Tune in next time. Thanks.